Hello, everyone. So today the market is opening pretty green on somewhat green on the day, 0.10. So this is not even green; it's like flat. But compared to yesterday, everything was red again. My positions that I currently hold also ended the day red. Not a big deal. This is normal. You can't expect that your positions will continue to go up every day. It's normal to have volatility. The only thing that continues to perform is impressively hyperliquid, which is one of the positions that I hold on my portfolio. And it has held despite other, for example, Avalanche is down like 60%. You have Ada, Cardano that is down, that went down like 60, 70%. We have Solana as well that is down about 30% and went down to the 40s. Hyperliquid is quite good. This um, this is not real, that print over there. Let me change to another one. HyperSTT. So this 35, 35, yeah. So this is the real chart, and we are down about 23%. And considering that the TGE, the release of the token was in November, it's a very early altcoin and it has been showing unbelievable strength. Actually, if we go to CoinGecko, let me pick it up here. If we go to CoinGecko, we can see that over the last 7 days, Ohm, funnily enough, I'm on Monero, I am on DEX, and I'm on Hyperliquid and Ohm. So I'm on all those four, but uh, Hyperliquid has been one of the top performers over the last 7 days, which is pretty good. So that's a nice position to hold. Let's see if it maintains. In regards to everything else, I'm going to do a quick check to see if there's new positions to open, if there's some things that we need to pay attention to. So yeah, let's start with Fine. Fine is doesn't have anything interesting. LCA spell. I was in spell when it broke out here on 0309, right? And I left it when it hit my exit. My exit, I don't share what rules I'm using for the exits, but it's not a big secret. It's mostly a normal, simple trail that is used in trend following, like a low of the low of the past, whatever bars. Okay, it's not that, but it's mostly that. So the secret in trend following when you trade trend or momentum systems is not exactly the rules, even though the rules are important, but it's how effective you are at extracting that return from that effect from the market. Okay, yes, the rules are important. Yes, you can't use any random rules, but to say I use an ATR based stop loss, or I use a moving average as the trail, or whatever, those details, even though they can add a bit more or less return, they won't make or break your system. Okay, or shouldn't. If they do, it's because you are overfitting your models, and that's not a very good idea. um, you have TRB, Pin, FTT, ARC, CFX. So this is the scan that I do every morning. Most of the, for example, I see Kava. I would like to see here a breakout, but I already know that I've already tagged it with an alert here. This is what I do every morning. I scan the market. I see what are the top performers today. I see what are the trends, and then I've already been doing this for so long that I know which assets will give me the highest probability of getting not the highest probability, but at what point do they give me an entry trigger based on my own models? Okay, because I trade systematically, like I say, and I know that I trade systematically. So every rule is defined: entry, exit, stop loss, whatever. I think that's how trading should be for most people. There's a few people that can indeed trade mostly discretionarily with rules that are not solid, but I could never do that. The only way I found consistency in investing, systematic trading, whatever you want to call it, is through defined rules and knowing my edge. What is my edge? Why am I getting paid for my exposure? And having all of that defined. Okay. Um, so, for example, give me a second. Okay. So we were looking at LDO. So I was saying that everything I trade is systematic. Everything is defined. Um, there's nothing that the only discretionary let's say decision that I make is what asset to pick. Okay, that's the only the systematic decision, because this is not usually traditionally at least trend followers wait for the end of day to take their position. So if for example LDO were to close above a certain price, they would take a position at the end of the day. I don't do that. I buy right at the breakout, and what does that happen is that I'm buying stuff as it goes up. So I'm not sure. For example, if five assets trigger on the same day, and they trigger all at they give me an entry signal all in the same day, but they might give me entry signals across the day. One gives me at 1 a.m., other gives me at 5 a.m., at 10 a.m. You get the point, right? And that decision is made discretionary, whether on which I'm going to take a position, which are just to be stronger. I use some narratives that I'm in the space for a long time, so I would prefer to take a position on LDO, right, than on FTT that we just crossed the FTX token, right, because FTX is no longer around. At least there's some speculation on the FTX token, but that's intraday gambling. Okay, and I would not take a position there, but a fully automated system, would be blind to those discretionary, let's call them, ideas. And so, yeah, that's the only discretionary position that I take. I want to know exactly all my trading is defined, exactly defined, but then there's I can still pick and choose which I'm going to take. And as you can see, I've been doing this. I try to keep this chart on my left. I'm still building it. You can see there's some errors here, just on this daily exposure chart. But my equity curve is this, the blue line, and I've been trading this model before 2023, but it was very segregated. uh, Not sure if that's the word. It was all split across chains, across decentralized exchanges, and so and centralized and decentralized exchanges over time. So I had all my capital scattered, and I didn't have all the records. So I decided to put in August 2023. I put everything I had on a few centralized exchanges, and I started keeping accurate records of it. And this is my performance since then. There's a lot to improve. I want to improve it, and this is the goal for this year. I'll be doing these videos daily and also sharing my thought process on what I'm trying to build. And yeah, this is the morning scan. I have most of the things that I'm interested in already mapped out. Um, and yeah, today I want to also, let me see if I have here. I'm also going through this paper at the moment. I'll be releasing this on my newsletter. I want to find out. So they discovered here on this paper, and I already knew this. We tested this before, but I want to retest it. And that's why I'm also taking spot data, 1 hour data. This is my data management center, let's call it. We take here data from Binance, from Bybit, other exchanges, and CoinGecko. And yeah, so I'm taking 1 hour spot data, I'm updating my database, and I'm going to be testing this simple seasonality strategy, when you just buy Bitcoin, I'm going to test across other altcoins as well. You buy Bitcoin at 9 p.m. UTC and sell it at 11 p.m. UTC. And this, as at least on the paper, they discovered that this was the returns from these simple seasonality strategies until 2021. But as you know, there was a lot of action from 21 to 2025, and I want to know what happened to this strategy basically. And this is it. It's just my process is all the same. Trading is supposed to be very boring, you know. It's not something that you come here and have action every day. You have to. This is when done well. When done well, when you know you are at your best. Trading, investing is very boring. It's just about analysis, developing models, or your own approaches. Doesn't need to be models. I prefer models, but you can develop discretionary approaches and executing on a daily basis. Every day the same routine of work. Okay, what is shown in movies or people trading, screaming, trading a lot of money, leverage, that's not reality. At least not for any professional trader I've met. Yes, there's times where you have to push the gas and you'll have a lot of size and volatility will be also present, and there's more excitement, let's call it, or at least less stability. But in general, you want trading to be very boring, very systematic. Yes, like I've made over 100% in less than 2 years, or 1 year and a half. More than I was up around almost 200% at one point. During this time, there's a lot of excitement, right? You are making money almost every day. But then um, things slow down, things calm, and that's the trading that I like. Just calm, knowing what you are extracting from the market, knowing that whatever you are extracting is likely to continue to go forward, and do the same process day in day out. I have some edges that are less common. For example, I was trading meme coins when they were hot. We built this entire thing, like a dashboard and everything to track those meme coins, and it was fun for a while. Um, but that is not the style of trading that you want to be doing. You want to be doing trading that is very stable, that is very predictable, let's say, and wait for months and years and not be thinking what you're going to make tomorrow or next week, but what you're going to be making next quarter or next year. I think that's more appropriate at least in my experience. Yeah, that's it for today. I'm going to be doing more of these videos every day, just sharing the thoughts, what I'm looking for in the market. Maybe I add some more stuff. I'm going to be adding when I have the time. Now I'm writing the article for this week, but when I have the time, I'm going to be adding more stuff up here. I'm going to also be launching new models this year because I want to be actively stress testing my own performance. If there's, let's say that I deploy a group of models next and they start to outperform me for 1 year or 2 years or whatever, then maybe I should consider moving my capital to those models instead, because I'm no longer needing of this initial model, right? Because if something is producing you more returns um, year over year, and you continue to allocate a lot of capital to the old model, maybe it should be time to start thinking or putting more weight on the new models that are producing more returns, even though that's dangerous. It's not as linear as that, because you it's not like, okay, I build a new model with a different rule, whatever, and then it starts making more money and I change all the money to that model. No, 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 that's not good. Ideally, you would just split capital across a bunch of different models, let's say, within the same effect. Let's say that you are doing trend following and you have one that is a breakout of the 50, 100 days or 20 days. Like you put a bunch of models with different frequencies, with different time frames, and then you allocate capital to those, regardless of how much individual rules producing in returns. And that's a more robust way, at least from what I see others do it and others professional trend follow CTAs do, is aggregating a bunch of rules together, not eliminating, not just deploying one specific model, because then you have very a single point of risk, right? If your current rules start to underperform the market and you start not making money anymore, you are very exposed to that unique rule. But perhaps the market is more conducive to more short-term type of trading or more long-term at one point. Then you have a bunch of models that are there to capture that, okay? And you are a bit more diversified in terms of that inside that risk factor, okay, inside that effect that you are capturing. I'm not saying that you are completely diversified. Of course, there's layers to this. There's layers, like there's diversification across models within the same effect. There's diversification across different effects. Like imagine if you're trading trends, if you're doing some carry, if you're doing some mean reversion, whatever. That's higher level of diversification, but that requires more specialization, in my opinion. Not specialization, that requires more of a team. Let's say it's already hard enough to capture one effect really well and understand it, and to capture others it's even harder. So in my opinion, that does requires a team. But then there's other layers of diversification, right? Across asset class. For example, I'm trading only crypto, but let's say that crypto tomorrow, whatever, Bitcoin got hacked. Yeah, I'm exaggerating, not hacked, but imagine that something fundamental broke about the Bitcoin, about Bitcoin, right? And people no longer trusted it because it was no longer secure as it once was, and Bitcoin started to go to a decline of 80 or 90%, all the cryptocurrency market would probably evaporate, right? And so if I'm only trading crypto, even though maybe I make money on the short side, if there's liquidity available in a scenario like that, I'm still going to be not making money going forward. So I'm not diversified at the asset class level. Then on the once then yeah then there's that diversification of asset class. You have a bunch of diversification types, but the first one that starts, in my opinion, is being diversified in the models that you trade for the effect that you are exploiting. And that's also what I want to go for this year. But for that we need to build infrastructure that I've been building. And yeah, that's it for today. Thank you.